Welcome to a special end of financial year edition of Taking Stock. I'm Tim Lincoln, and joining me is Kien, Trinh, our head of Stock Doctor Research, and we're about to stream to you all things share market. Welcome, Kien. How are you?
Not too bad, Tim. It's pretty cold down here in Melbourne still, given it's middle of winter, but we're lucky we've avoided the flu, so all positive on our part.
Yeah, need to have the beanies on at the footy tonight too, that's for sure. Just before we get started though, Kien, a quick reminder for all of our members that all of the information we share today is all general in nature and therefore shouldn't be construed as personal advice. And all of the data and performance metrics that we also display, all historical and shouldn't be relied upon as a guide for future performance. Well, Kien, the financial year 25 was another standout year for equity markets, but it really was a story of two halves. The first half of the financial year saw strong gains on the back of easing inflation and optimism around interest rate cuts. But the second half brought a fresh wave of volatility as renewed tensions in the Middle East drove up oil and gold prices, and US President Trump's tariff threats rattled investors. Yet once again, markets proved remarkably resilient, underscoring the importance of blocking out the noise and focusing on what you can control. And that is managing the stocks in your portfolio relative to your investment profile. For the year, the Australian All Ordinaries Accumulation Index, that includes dividends, rose 13%. Even better, our starred growth stocks outperformed, climbing some 16.5% to the year June 30, driven by standout performers like Pro Medicus that just keeps on flying, Technology One, Hub24, Netwealth, Codan, and Brambles. And here's the kicker, Kien. Over the past 30 years, our star growth stocks have beaten the market in 25 of those years. A really, really impressive result. And that's a rate of 83% positive years against the market. So very proud of those numbers, Kien.
Yeah, it was a very strong year for growth stocks, Tim, but it was also a decent year for income investors as well, with our star income stocks delivering a total return of around 11.4%. And this also includes a healthy 6% yield for income investors over that year as well. We've had strong performances from the banks and financials, and that helped offset some weaker returns in retail stocks, which kind of were under a bit of pressure. Encouragingly, though, we started to see early signs of a recovery in the REITs, the property trusts, and also utilities like APA, which stand to benefit from falling interest rates.
Yeah, good stuff, Kien. And meanwhile, in the US, they had a stellar run also, with the S&P 500 climbing 14% over the financial year to record highs. The technology sector led the charge as worries over big AI investments eased, with giants like Nvidia and Microsoft smashing earnings expectations, even amid lingering tariff concerns.
Yeah, incredible with all that tariff uncertainty, Tim. But the optimism continues to run high. We had M&A activity that was surging, and in the AI space, Apple snapped up Perplexity AI, while Meta, they launched its super intelligence division led by Alexander Wang after acquiring Scale AI. So a lot of things happening in the AI space. But back home, we had major acquisitions, including the James Hardie buying US decking company AZEK, and Xero acquiring payments platform Melio, though heightened financial risks and profit dilution, especially to their return on equity, led us to drop these from coverage. Other standout deals included WiseTech's acquisition of US logistics software firm E2 Open, and of course, Ridley's purchase of Dyno Nobel's fertilizer business.
Yeah, certainly no shortage of M&A action either, Kien, in the gold and mining sector. But it wasn't just AI and corporate deals driving markets this year. Massive inflows into passive investment vehicles like index funds and ETFs gave equities a powerful boost, sending valuations higher, even as earnings expectations moderated. Today, passive equity funds make up about 56% of total equity investments, up sharply from just 36% a decade ago. So having massive influence on momentum of markets at the moment, really supporting the current bull run.
Yeah, definitely. This momentum and size trend is certainly having an impact on markets. But as passive investing takes over, Tim, it also ramps up the systematic risk, and it can amplify share price swings, especially during downturns as well, and inflate valuations of major index stocks. Just look at Commonwealth Bank, for instance, which is trading at a lofty price to earnings multiple of around 30 times, despite its limited growth prospects.
Yeah, really important that we've got the ability to outperform the market still as bottom-up stock pickers, and we believe we can do that. And the performance figures we showed before, based on our star growth stocks, prove that that's possible. Because in order to add value from an investment or bottom-up stock picking perspective, it's important to outperform the market with this ETF and passive investment phenomenon kicking in. So it's good that we can do that. And at the end of the day, we're really got to just make hay while the sun's shining. If there is that underlying influence from passive, then we just got to ride that wave. But ideally continue to outperform. Kien, another major risk with passive investing too is how it can fuel speculation, pushing speculative stocks too much higher, because remember, ETFs and passive just invest in everything. They invest in the entire index, and that includes the good, the bad, and the ugly. So speculative stocks can rise too. That gives investors a false sense of security. We've seen this play out with some unhealthy businesses like data analytics firm Catapult and gold explorer Spartan Resources, which have surged despite really weak fundamentals.
Yeah, these companies don't make any money at all, Tim. And the reality is that corporate insolvencies are still climbing, even as interest rates begin to fall. Over the past year, bankruptcies have spiked by around 34%, and that's continued the 3-year upward trend, as you can see on the chart on screen.
Yeah, we've also seen several high-profile collapses this year too, Kien, including regional airline Rex and women's fashion retailer Mosaic Brands, which owns labels like Noni B, Millers and Katie's. Interestingly too, EcoFiber, ticker code EOF, once a borderline star growth stock a few years ago, they produce hemp-based products. They also fell into administration. While it saw early success, mounting regulatory challenges in the hemp industry eventually crushed its cash flow, leading to the collapse in May.
Yeah, and that's why it's crucial to stay vigilant as we approach this reporting season. In Australia, you've got earnings downgrades, and that's accelerated in the second half of the year, especially in retail and those consumer sectors. They are under pressure from tighter household spending. Notable downgrades just recently came from Setar, Kathmandu, Accent Group, and even homewares retailer Adairs. And the chart on screen really shows this. You've got the All Ords Index in blue, and that's against the forward earnings estimates in black. And you can see a clear divergence in recent months with share prices rising, even though earnings expectations are falling. And that's driven partly by passive investment flows, that share price moves, optimism over the US trade talks as well. And those easing geopolitical tensions in the Middle East really holding up the share prices. But this makes it more important than ever to manage your stock-specific risks as we head into the reporting season.
Yeah, super important, Kien. And Stock Doctor is a great tool for managing these risks, especially ahead of reporting season. You can set alerts to track earnings trends and monitor changes in short interest under Golden Rule 4, giving you insight into institutional sentiment. Right now, stocks like Polynovo, IDP Education, Lifestyle Communities, and Corporate Travel have elevated short interest. Use the portfolio manager also to keep your portfolio diversified and focused on high quality businesses to better navigate the upcoming volatility, and especially keep it aligned to your investment profile relative to your stage of life. And by taking profits, really important that take profits on stocks that have rallied too quickly, or where you've got an overweight position in the portfolio, and you can build up a nice little cash pool to take advantage of oversold opportunities in the weeks ahead, especially as companies release on the back of reporting season. And now to Under the Microscope, Kien. And this week, we take a good look at Australia's biggest and most valuable bank, star income stock, Commonwealth Bank. CBA shares have soared nearly 50% over the past year, Kien, leaving its peers in the dust. So, Kien, what sets CBA apart from its competitors?
Well, Tim, it's all about CBA's premium qualities. You've got a superior return on equity, the dominance in their household deposits that give them lower funding costs and higher margins. And also, they've got a more conservative risk profile in residential mortgages. You know, they've got such a strong market share there. And added to that is the fact that they've got industry leading digital platforms and they've got a strong brand which keep customers quite loyal.
Yeah, and a 50% return is very impressive, isn't it? Indeed, especially for a business like a bank over the last 12 months or so. But banks generally have limited growth opportunities also. So that's what makes it even more impressive. What's been driving the share price higher over the last 12 months, Kien, that's led to, potential overweight positions in members' portfolios?
Well, Tim, there's several factors here. You've got CBA's earnings, which have proven quite resilient even as other banks lowered their forecasts over the bank reporting season. In their recently quarterly result as well, they beat market expectations with stable margins. They had solid volume growth and also tight cost control. On top of that, with a 12% weighting in the index, CBA benefits from passive investment flows as well. We've also seen an increase in foreign buying with funds using CBA as a way to gain exposure to the Australian dollar through a high quality liquid stock.
A lot of money finding its way to CBA. As a result, the stock's trading at a steep premium under Golden Rule 5. And with a fully franked yield of just 3.8%, Kien, does that put, I don't know, the sustainability of yield and its tenure as a star income stock at risk?
Look, Tim, you know, with such high valuations, this could be a risk. But really, when you look at these type of businesses, high quality stocks, they can stay expensive for long periods. Quality always comes first here. And among the banks, CBA's dividend looks like the most sustainable due to its strong capital position and rising dividend expectations. But you know, even with the banks, you've got industry broad risks, and they still remain, including margin pressure, for instance, from rate cuts and competition. You've got potential for rising bad debts as the economy slows, and that weaker economy as well. But you know, with these things, you can't anticipate them.
Right. It's a bit of a potential conundrum depending on the position that it holds in our portfolios at the moment, Kien. So ideally, what should we consider? What can we potentially do?
Yeah, it really depends on an investor's individual objective, Tim. You know, if you bought CBA long ago, so you might be enjoying yields closer to that 10% mark as opposed to a 3%. So in that case, you might prioritize income over capital gains or losses. But if CBA does come an overweight position of your portfolio, you may consider trimming back to a more neutral position, especially ahead of the August results, Tim, where it appears that much of the good news has been priced in.
Hmm. And if you're exploring other bank options, don't forget to use the peer comparison table at the bottom of the 9 Golden Rules page to review key performance metrics side by side against each of the peers. And now to question of the week. And it's an exciting time of year and one where we've got to start to really get prepared for the reporting season. So a really great thing to be doing, Ken, is really trying to unearth some new opportunities or emerging opportunities. So how do our members do that in preparation for reporting season?
Well, Tim, members can use our powerful Stock Doctor filter to screen for opportunities. However, you can quickly scour for opportunities by referring to the preset Tim's growth or income stocks with potential.
Okay, and with this filter, you can sort by fields such as those with the strongest earnings revisions. I think, from a momentum indicator perspective, that's important, or even price targets is also another good momentum indicator to use, or those that are trading at a significant discount to fair value. Quality businesses trade at significant discounts to fair value always represent a bargain or a really good opportunity. For example, from those in the list, the potential opportunity is Web Travel Group, which is trading at a large discount to the target price based on 17 covering analyst scan.
Yeah, that's an interesting company, Tim, regarding web travel. since they completed their strategic demerger, earnings revisions have been quite stable, as you can see there. And the company is now focused on their B2B business, what they call web beds. Now, this platform provides hotel room inventory wholesale and also sells it to travel agencies and tour operators, giving them a more stable recurring revenue and also lower customer acquisition costs and a very capital light model. As a result, their return on equity is trending higher, as we can see under Golden Rule 3.
Yeah, and another opportunity trading at a big discount to its fair value too, Kien, is smart parking. This business installs smart parking systems like sensors that make parking easier to find and manage. They also offer mobile apps that help parking officers issue fines. I don't like that app too much, but anyway, we've got to be more careful these days in where we park. While the stock at a low liquidity level previously, recent excitement around AI and its strong profit results have increased trading volume significantly.
Yeah, that's right, Tim. And smart parking, they stand to benefit with strong return on equity and also solid profit margins as well. Once their systems are installed, if you think about it, they incur minimal ongoing costs while also generating high margins. And they've got that recurring revenue from software services and data insights from their clients.
Very good, Kien. And there's plenty of other opportunities, aren't there, in the list to spark new ideas for our members relative to, again, the type of businesses you look for based on your investment profile. And remember, some of these names could enter our Star Stock universe as we move through reporting season as well, so long as the liquidity constraints are there and etc. But remember, this is just a list of companies. You've got to drill into each of these, especially the ones where the data looks interesting on the filter, but you've got to drill in and do your thorough due diligence to make sure that it does meet your specific requirements. All right, Kien. Well, that's it for another end of financial year recording of Taking Stock. I hope our members enjoyed it, and always great sitting down with you.
Likewise, Tim. And remember, risk management is so important as we head into that reporting season.
And I think too, yeah, risk management, Kien, and also because we are bottom-up stock pickers, that's what our methodology is. It's really, really important at the moment that we do block out that geopolitical and macroeconomic noise. Really, really, really important, because it can distract us and force us to deviate and make decisions that are probably not in the best interests of long-term positive results for the market. So yeah, be careful there. Block out the noise, really important. All right, can't wait to see you all again on Lincoln Live next week. For those that love to tune in, have a happy, healthy and prosperous week.